Welcome to the Victor H Investing live stream. And it is good to be with you here on July 13th. It is a Saturday after a week of trading, a full week. We had a partial week the week before, and it was certainly an interesting week where we had a severe down day, but overall markets recovered on Friday. So wanted to take a look at what's going on with the exchanges, the indexes, and see what's going on with stocks. I've done a little bit of, I would say, changing to my portfolio that I wanted to talk about. I sold three particular stocks completely out of my portfolio. I'd like to share with you why I did that and the changes I made and the intent of how I'm going to proceed with my portfolio for the remainder of the year. It is great to have several of you on the live stream so far. Shadow Guy, it is great to have you. Thanks for joining, and I appreciate all your support. Let me know what stocks you want to take a look at. Cinematographers, I really appreciate you joining. Looks like you have some really good comments on Adobe. I'm going to get into those and really appreciate you coming with a few ideas to talk about. Best of, good to see you again. Thanks for joining. And I think it's Kidder. And you're tuning in from Israel. Awesome, man. That is great. I know we've got a couple of countries typically represented on the live stream. And we've got Switzerland. I'm in the U.S. Israel. That is awesome. I know that we also have a viewer from Portugal. And if you guys want to mention where you're tuning in from, that'd be great. And then Android PC gameplay. Thanks for joining, man. Good to see you. Thanks for joining. So we'll take a look at a few stocks today. I had a couple in mind. It looks like Shadow Guy, I wanted to take a look at Loews. That was a really interesting stock we looked at last week. I thought the fundamentals looked really good. And we take a look at that again. There's no harm in looking at a good quality company. And so you're a kite surfer. Okay. And kiter. Sorry about mispronouncing the handle. And kite surfing. That's something I haven't done yet. Maybe someday. I've done a lot of things, but not that one. All right. So let me go through a couple of just kind of setting the table on where we're at with the stock market and then get into some of the changes I've made and the reasons for it. And then we'll get into some stocks. So let me change the view here, make it a lot easier for you guys to see. So in general, the market is up really nicely. Year to date, it's up 18.4%. That's a great return. We're 6.5 months into the year, and it's a really good year. Keep in mind, in 2023, we're up 25% on the S&P. The S&P is an index of the 500 largest cap stocks that are traded on the stock exchange. So it really does represent, probably the premium stocks, and it's looking really good. When we look at the 5-day, you saw that on Thursday, we had a pretty good correction. The Federal Reserve didn't announce anything. The inflation data came out, and it's showing that inflation is coming down. So that's good. That's good for the economy. Hopefully it's good for prices, or especially around food, for people to, buy food and all the essentials that they need. And what that caused is a rotation, a shift from these mega caps, right? NVIDIA, Microsoft, Apple, to smaller stocks that tend to be more sensitive to interest rates. So there was a pretty good rotation into smaller stocks. Now, it was a one-day event, and it also went into Thursday. Small stocks did well on Friday as well, and that's 2 days. So it's not a trend, right? Not yet. It was probably a good start, but it's not a trend yet. The reason I say that cautiously is I've been really disappointed with small caps. Here's the Russell. Even after those 2 really good days, when we look at the return on the Russell 2000, it's 6.7, which is nowhere near where the S&P is. So small caps, will they begin to work? Potentially. I mean, it's always, really a good idea to try to look for really good companies when they're smaller, they're younger. Um, if you look at Uber, it's not a company that was around 20 years ago. If you look at Airbnb, wasn't around 20 years ago. So finding these smaller companies, life sciences, I think I like United Therapeutics. It's an interesting company with good growth rate. You can find companies that are smaller and then they really just take off, which is really fun to do. Having said that, I'm carefully monitoring my small caps. And the reason for it is if you look at the last year and a half, they haven't really performed anywhere near the big mega caps. So they haven't kept up with Nvidia, Meta, Microsoft. So we'll see if that changes. We'll see if that changes going forward. The Dow did fairly well. It's doing 6% for the year. These tend to be the older companies that pay dividends. And I know some of those names are easier to understand because they're companies like, Coca-Cola and companies that we've kind of grown up with and are very familiar with. So that's where we're at with the indexes. Now, something that just started this past week is we had earnings, and earnings officially kicked off, I guess, on Friday. You had the big banks announce. And what was interesting about the big banks, and I'll cover Citi because that's one of the stocks that I own, I cover closely, but also comment on the other big banks, is their earnings were fairly good. I know for Citi, they grew their revenue. They're really doing well, having very good return on their capital, yet their stock came down. Overall, Citi's doing really well. If you saw a short that I released this morning, it's a really good return over the last 7 months or so, 8 months. It's had a great return of 68% on Citibank. And I think it's got more ways to go. So that was the first, earnings call that I paid attention to on Friday. But coming into this next week, we have some more names. Nothing humongous. You got Bank of America coming, more financial services. You got Progressive, which is an insurance company, and you have on Wednesday ASML, which is more of a semiconductor company. J&J, healthcare, pharma. Elevance is a healthcare payer. I own Elevance. I've got a pretty good position there. I've owned US Bank in the past, but I'm currently don't have any shares in US Bank. I'd be curious to see how they did. That's more of a regional mid-sized bank. Ally Financial, I just sold it this past week, and they've done really well. For the past 5 years, I'm very happy with the return, and I wanted to get out of some of the stocks that I think have done well, kind of got to a point where I think is a good exit out of that particular stock. And let me see where things settle. The economy isn't doing great, but it's not doing terrible. We don't have big unemployment yet. I know unemployment is rising, but I just don't see how the economy can sustain really big purchases. And LSE is very, very dependent on automobile sales. So wanted to get out of that stock. We'll see what Ali has to say on Wednesday. Other notable names, United Airlines. Now, United Airlines, I invested in that stock and kept it for about 2 years, expecting that air travel was going to return, which is what happened. So my expectation from economy and kind of like what happened was somewhat accurate. But the stock just didn't move. It was kind of interesting. Air travel, record air travel in the U.S., records. Never, I think the day, July 5th ended up being the highest travel date ever. And that's really awesome for volumes. But for some reason, the ticket prices, I guess a lot of the low cost regional players have been really battling with price and have kept the airlines from being really profitable. So that's another stock that I sold completely out of this week. I took a small gain, and really the reason that I'm getting out of United is that I just don't see how that particular economy is going to get any better over the next couple of years, but I see more risk than reward. If after establishing record, air travel, if the stock isn't going to really move on that type of news, then what is going to move that stock? I think the PEs on airlines are super low, like 6. So I got out of United. I took a small gain, and oh well, not every investment I'm going to make is going to work out exactly the way I wanted it. So I got out of United. And the third stock that I got out of, I'll put it out there, is MPW. That's a risky real estate investment trust. And I've been kind of on the edge of that one, being in or out of my portfolio. And I just wanted it out. I wanted to improve the quality of my portfolio from a risk perspective and really be in a position with more cash. I continue to feel that the market is priced quite high, and I wouldn't be surprised if we had a pretty good correction. I want to have enough cash to really take advantage of any type of correction that comes up. And also cash is, I'm getting paid 5% on my cash. If you go to Moomoo for the first 3 months, you get paid 8%. I mean, it's okay to sit on cash making 5 to 8%. Because for the remainder of the year, I'm already sitting on a very good gain halfway through the year. I can protect that gain by putting a pretty good size cash position, earning 5 to 8%. Moving on to Thursday, we've got other companies. Abbott is a pretty big player in healthcare. Domino's, more regional banks. And then I think Netflix is going to take the most attention on Thursday. Netflix, in my opinion, is the number one streamer. It's got an advantage against the rest of the players. I don't know that anybody would argue with me all that much. Disney tried to be a competitor, but I think Disney's got their hands in a lot of different businesses. Streaming's just one thing they do. Where Netflix, this is what they want to be. This is who they are. I think they're really going to take that leadership position and keep it. I'm going to do a deeper dive into Netflix just to get prepared for next week, and I'll do that later in the live stream. And then Friday, we're going to have American Express. I've never been a investor in American Express. Travelers, which is insurance, and it looks like we'll look at Loews and look at Travelers a little later in the live stream. Travelers, I believe, is one of the companies that Warren Buffett is invested in. Warren Buffett really likes insurance companies. I think insurance companies provide quite an attractive, model, which is, they sell everybody insurance, or they sell businesses insurance, and they get to keep those premiums and invest them. And that cash pile really becomes lucrative for them. So they can make money on the policies if they wrote them correctly, if their actuaries were accurate. And then the cash pile that they have, they can invest it and make a good return. Right now, the return's pretty good. I just mentioned cash is paying 5 to 8%. Imagine if a professional money manager was on top of that. They could probably earn 6-7% per year. That's all margin to an insurance company. So we'll take a look at Loews and Travelers. So it's now heating up. Earnings are going to stay super active for the next couple of weeks. It makes investing really interesting. You see a lot of headlines come up. I mean, Netflix is probably going to be the biggest name that releases their earnings next week. And after that, the big names will start coming out. So Alphabet, Meta, Apple eventually. And those big names will draw a lot of attention. It'll be fun to watch. All right, so looking at sectors. Now, for the longest time, it seems technology's kind of been winning the return race by a big margin. They've done really well. So technology stocks have really just commanded the market, but it's really begun to get a little more distributed, the returns. If we look at the monthly, over the last month, consumer discretionary actually had a very good return, 6%. If you look at consumer discretionary as a sector, technology was in second place, which is very good, but it's not. What's good is that you have several sectors now somewhat near each other. So the investing is now kind of getting more distributed. It's not just one sector that's just doing great. and pushing the S&P index up. Real estate had a pretty good month. Financials had a good month. Materials, I mean, it was a good month across the board. Year to date, technology continues to be, the leader for the year. Communication services, which includes Netflix, Alphabet, Meta, it's doing very well. Healthcare, it's beginning to wake up. I'm really optimistic about healthcare because I think it hasn't done so great over the last 2 years, but it tends to be, if you pick the right companies, a very profitable sector. If you think about pharmaceutical companies, they have very good barriers of entry against their competitors. So I continue to be optimistic that I probably have good positions in healthcare that are going to perform really well for the remainder of 24 as well as 25. Then financials is right there. Financials has done really well. Big banks, insurance companies, to point out a few industries that have done really well. Utilities, surprisingly, is doing really well. I don't invest a whole lot in utilities because I've never liked the proposition they've had, but they're doing okay. And then from there, all other things. Now, it's been a good year. So all these sectors are showing positive signs. Again, I continue to think that the market is a little expensive and we may see a correction at some point. So I'm going to look at some companies now as we look at companies. I'll start with Loews, and then I'll come down the comments and make sure that we cover the companies that people want to talk about. So Loews, I think we looked at it last week. This is an insurance company. I think insurance companies provide a very strong proposition. I know that in the US, and these guys are, I'm not sure where they're located, but I'm in Allstate, and it looks like they might be located in New York. I was going to say in the US, insurance companies had a tough, call it 2022. And the reason for it is asset values went up significantly. Homes, assets, hard assets, the value of those went up. Car values went up. And when you think about like Allstate as an example, now when a car would be in a collision and it would have to be replaced, there was a higher market value. So the insurance company had payments for claims that were higher. So 2022 was not a great year for insurance companies. The other limitation that insurance companies have is in the United States, and depending on the state, there's governmental oversight. So they can't just adjust prices as they see fit. They actually have to go through a regulator, put in essence, analysis that says, we want to continue to insure people in this state, but our costs have gone up. And they can prove that they effectively did that in 2023. And that enabled them to get better premium prices to the insurance company. Insurance prices have gone up significantly. I think it's been reported on various channels, I'm talking about like CNBC, where insurance rates are up upwards of 30%. And that's because there was a little bit of pent up price adjustment because insurance companies have to deal with regulators. So now that they have their pricing right and you have inflation beginning to come down, the insurance companies are in a pretty good position where their businesses are going to be strong. Their businesses are going to produce really good free cash. And I think they're going to have a couple good prosperous years. So that's my feeling about the industry of insurance. I think it's a good one right now. Loews provides a PE ratio of 11.4. That's very good compared to especially technology. I mean, that seems like a bargain. Their dividend and investing just based on dividend is I don't recommend that. I just like seeing dividends because if you're a income investor that depends on dividend rates, this could be a very good idea. And I know Shadow Guy, you pointed out something that was interesting. In Switzerland, you guys don't like dividends because they're taxed very high, but appreciation on the stock is, there's preferential tax treatment to that. So that might be a good idea. This stock here might be a good idea for that type of scenario where you don't want dividends, you want appreciation of the stock. Speaking of appreciation, this stock is up 28.7%, a very nice return. And I like charts that have this upward and to the right trajectory because if anything, it gives me a sense of confidence that it's going to continue to go up and to the right. I don't like seeing jagged, 1 year it's up, 1 year it's down. If you look at like the Tesla stock over the last couple of years, you see what I mean is the stock really flies up, it really crashes down, and then it flies up. Well, which company are you buying, right? This one here, if you look at, understandably, when you had COVID, everybody was like, oh my God, what's going to happen to insurance companies? So there was a big factor, which was COVID. They didn't, Lowe's didn't create COVID. They just had to, adjust to it. But ever since COVID, it's been somewhat up and to the right. So that's a very good trend in the company. So this is a good company to look at. Looking at their revenue, it grew in 2023. As mentioned, insurance companies had a tough 2022. As I set it up, there's reasons behind that. And I like buying into, first, I want to buy into an industry that I think is a good industry to own. And I already talked about insurance. I also want to know that the company is being operated, right. You can have a great company operated wrong, and that might compromise their results. Well, what I would point out is in 2022, it's probably not the management team that made the company lose revenue. It was the whole environment of, hey, the insurance rates were not correctly priced to what was going on with inflation. Asset values were going up really high. So this year here, I look at it as, yeah, insurance companies kind of had a tough year, but it wasn't their fault. It was just an environment that caused for those losses, the loss of revenue, because they didn't want to write policies that were just going to be complete money losers. But in 23, they really bounced back. So that's really good to see. Balance sheet, not a lot of cash, just as long as the debt is in good shape. Their growth of debt isn't too bad. Actually, it came down a little bit, so that's good. And it's been coming down over the last couple of years. That's good to see. Okay, and cash flow. So cash flow, and again, I like seeing when a company is growing and the trend is up. You can see they went from 700 million in 19 up to 3.2 billion. It's a very good trend. Again, it makes me feel more comfortable that, hey, these guys are on a path, and the path is up. The path is up on free cash. As you guys have seen on my videos, I use free cash flow as one of the principal valuation methods when I look at the company. All right. I'm going to look at a few statistics. So the market cap isn't too bad at 17 billion. And I want to look at debt to EBITDA. So debt to EBITDA, 3.46. It is a little high. But looking at all the other fundamentals, I'd be okay with that. I would just want to make sure that, and we did see the balance sheet they weren't growing their debt, which is good. They were actually bringing down their debt. Very good sign. And they produce a lot of free cash, so they can continue to reduce their debt level. So that's okay. Return on investment capital is a little low, 6.85. It'd be nice to see that a little bit higher. And so overall, I'm seeing really good fundamentals. Now, I'm pretty locked in on Allstate. I've got a good position there. It's done well for me. I'm comfortable with Allstate. I wouldn't be interested in another insurance company, but if I didn't have Allstate, I'd be very interested in investing in Loews. I'd want to do more analysis. And that's my opinion on Loews. Let me see here. So Shadow Guy. From my research on Loews, insurance is only part of their business. They also own hotels, packaging business, natural gas pipelines. Wow. So they're like a conglomerate, huh? Let's take a look at their website. So So Lowe's, yeah, they have a pipeline. Lowe's hotels. I had seen that brand around their hotels. I think it's like a luxury brand. I've never stayed at a Lowe's, but I think I've noticed it. Okay. And they have a packaging business. So this is like a conglomerate. It's like a Berkshire Hathaway, so to speak, that invests in different businesses. So I wonder what portion is what. Let's take a look at. So financials. So I want to see what the split is between revenue. Is it like 80% an insurance company? What are the other pieces? So let me take a look at that really quick. And I'm going to go to the SEC filings because that tends to give me the uh, the breakout very cleanly without a whole lot of like messaging from the company. All right, so all right, so here we have the balance sheet. Okay, perfect. So revenue. So they are predominantly an insurance company, right? So they're 2.4 in insurance. Or wait, maybe I spoke too quickly. Statement of operations. So it seems to me that a majority of their revenue is from insurance. They're treating these other companies that they own, like the hotel and the packaging business, as fully owned companies. And as those companies, make a profit or a loss, then they bring it into their income statement, which somewhat doesn't represent the total revenue of like the Lowe's hotel or the packaging business, because they're just bringing in the income from those investments. So I'd want to take a look at that. It seems like they're predominantly an insurance company, and then non-insurance warrant revenue. I'm not sure what that is. Operating revenues, others. So you can see that more than 50% of the revenue is from insurance premiums. So that's interesting to know. And again, they're reporting like an insurance company, not a pure play insurance company, but you can see in their income statement that they are putting out like their insurance claims and so forth. So that's interesting. This is different. This isn't a pure play insurance company. Now, do I like conglomerates versus companies that focus? It's all, you know, it's dependent on, do those businesses somewhat complement the overall company? For example, you have Alphabet. Alphabet started with Google search. They dominated search. They still dominate search. And they decided, hey, I think it'd be interesting to acquire YouTube. And they acquired YouTube. Now, is that completely out of their domain? No, not exactly. It gave them a place in the media, especially the social kind of aggregated media space. And it's done really well. YouTube's one of, very valuable part of Alphabet. Now they're getting into Waymo, which is self-driving cars, and they're getting into AI as well as technology infrastructure. Those things are all within kind of like the same kind of scope of, I would say, intellectual capital that the company has and knowledge. So that one makes sense. Now, insurance, what does insurance have to do with packaging? Not a whole lot. So I'm not seeing a lot of synergy there. What does insurance have to do with running a hotel? I'm not seeing a lot of synergy there. So I would want to like make sure I understood that, because what's the sense in owning a company that wants to act like a mutual fund? Hey, I'll just go buy a mutual fund. But I like in a case like this, I would rather go with a pure play. I think I'm going to talk about Netflix in a little bit. Netflix is as pure play as you can get. Hey, they do streaming and they're doing content for streaming. They just want to focus. I like that versus a company like Berkshire Hathaway that says, hey, we're really smart at buying companies at a discount. And we're going to have a variety of companies doing a variety of things, from doing insurance to selling See's candy to Apple. Well, I think that kind of is just like buying into a mutual fund. So that would be one of the things that I would point out on Lowe's is I'd prefer for the company to be focused, maybe have a couple of related businesses that make sense, that the intellectual kind of whole, the intellect of the company, what they're really good at is being served, is going into a couple different types of companies within the same somewhat universe. Okay. So that's Lowe's. It's a quality fundamentals, but I kind of dissected that one for you. I appreciate it, Shadow Guy. Hopefully that is interesting. And then you got one more comment there, which is Kramer gave them about several years ago, mixed feelings about them. Gave them a shout out a few years ago, mixed feelings. Yeah. So, again, I would think about it this way, which is, do you want to own an insurance company? If you do, you have very good choices. There's very good insurance companies to look at. Or is this one in particular have a really strong proposition that you want to take advantage of? That would be one of the questions I would ask myself. So thank you for the question. All right, so let's move on to the next one. Cinematographer showed up. He showed up with some good stuff here. Adobe announced it would allow third-party tools such as OpenAI's Sora to be used in its editing software. Adobe also have now Ink Magnifique AI as a plugin. Interesting. Okay. So yeah, so let's talk about that. So I do own Adobe. I think Adobe is a really good company. It does software products for, I'm going to call it the kind of creative type of task. Adobe Acrobat's a big company, but a lot of graphic artists use them. So they have very strong products. Their market cap's $247 billion, $20 billion of revenue. It's a really strong company with very good profitability, very good cash flows. Now, AI. So AI could be a big opportunity and a big threat all in one, right? If AI becomes this, method of creating, visuals and icons and thumbnails, videos, and it becomes far faster, easier for the creators, that means fewer people are probably going to need to license software from Adobe, potentially. But if Adobe kind of takes AI and really will harvest all the opportunity out of it, for example, this partnership with OpenAI, that's a really good idea because it could expose them to new customers, and it could also help them cross-sell and create new products that they could sell to their current customers that maybe are interested in, hey, I use Adobe products, but I would be interested in using the AI piece. Another example that is similar is Meta's doing a really nice job with AI. I covered it last week, and so I'll do it quickly on this episode. Meta's got billions of users, monthly active users. So it's very easy for them to present, hey, check out our Meta AI, and then people can use it. I've used it, and it's really good. So they could very easily grow their users on AI. And right now, AI is red hot. So I think Adobe needs to do that. If Adobe can grow their AI users, they're going to be relevant. They have to do it. Because if they don't grow their AI users, they may be replaced by the next cool thing within their industry, in the types of users and people that they sell to. So I'd be very curious to see how that evolves. I think Adobe is a very quality business, in my opinion. When I look at businesses, I want to know that I'm buying one of the best. And when it comes to the type of software that Adobe creates, It's the best, if not top in many markets for the creative software space. Okay, so good stuff on Adobe. It's Adobe's had a good month, up 22%. And Adobe, for some reason, the market has misunderstood Adobe a couple of times. You could see that Adobe really came down. I bought Adobe like in this zone, and then it really went up, and I sold it. I sold that position and said, hey, thank you, Mr. Market, for that nice gain. Thank you very much. Then the market said, hey, we're going to sell it off again. So I started buying again. No, nothing wrong with making money, right? Nothing wrong with making money on a stock that I'm very familiar with. Now, I don't like seeing this because this is kind of like, who's confused? The stock market? Is the company doing something terrible? Now, I would say that I've looked at Adobe closely. It hasn't been doing anything terrible. It's been Adobe. It's been growing. It has good growth. But I think the whole AI story, it has swings. Like at this point, people began to think, the market is going to change. AI is going to completely make Adobe irrelevant. And I could understand why that comment would be made or why that story would be told, but I think it's overly done. So once we kind of got through that range of concern and fear, the stock market realized, no, this is a quality company, and it rose. More recently, I think software companies were being sold off because there was so much attention on AI from an infrastructure perspective. NVIDIA, GPUs, the semiconductor companies have just taken off. And if you see my other videos, I voice my opinion that semiconductors very overpriced right now. So some of the money's coming back. Some of the money's coming back to Adobe. I'm going to talk about Zoom in a little bit. I see it in the comments. So these software companies are beginning to get some of this investment back. And FYI, Microsoft's a software company. It's the most valuable company in the stock market. So software companies are a very good business that I want to be a part owner in. Profitable. They have good competitive barriers against its competition, because if they're the number one product in its category, it's hard to replace them. Intuit has TurboTax, the leader. It's had that franchise for a while. It earned it. That's a big competitive advantage. As an example, Adobe has the same competitive advantage on many markets where people, in school use Adobe products, then they go into industry and they use them for 10, 20, 30 years. That's great for their business. So thanks for bringing that example, cinematographers, to the session. That's good stuff. All right, so I think I already said hello to Android PC. Let me say hello to you again and move on with some opinions. So, N. Kiter, let's talk about Zoom. Love to. So, Zoom has had a super interesting last 5 years. When you look at their chart, right, it's like, holy smokes, man. When we got into COVID, this is one of the stocks that just flourished. And I'm going to go to Google because I get a better stock chart tool. So when we look at their chart, COVID hit and these guys just took off to the moon, 632% in less than a year. Wow. Incredible. And, some of it was warranted, but what the market did after that is it really sold off, because it's like, well, it's not going to keep that type of growth rate. And my observation is that, the loss of market cap, because you went from the stock was trading mid $500 per share. Now it's down to 57. So it's down close to 90%. Was there loss in revenue? And the answer is no. Revenue has actually been increasing. When you look at their revenue, right, you look at COVID hit in 2020, their revenue went up 325%. Okay, obviously that was a phenomenal year. But it also grew 54% in 21, 7% in 22. They're getting bigger, right? They went from being, In 2019, there was $622 million. They exploded. They were 2.6 billion, then 4.1, now 4.4, now 4.5. So the growth is getting harder because they're bigger, but this is all positive in my opinion. I think the quarterly is also positive. So they're positively growing the company and they're profitable. Now they've achieved very good profitability. So they have very good net income and they generate awesome free cash flow. You look at their cash flow, it is a great cash flow rate. 1.4 billion in free cash flow. And you look at their market cap, 17 billion. Their free cash flow, and I should have it readily available. I'm going to look at my analysis on Zoom. So here's Zoom. This is what I show in my videos. I haven't updated the stock price, and I don't think it's correct, but we'll just kind of show this as an example. The piece that I wanted to show was if you look at the cash flow yield, this year I'm expecting they're going to do 1.5 billion. And when you look at the cash flow yield of that amount divided by their market cap, you have an 8% free cash flow yield on a growing business. That's very profitable. I'll buy that. I'll buy it. And I have a good position on Zoom. I just don't understand why the market is not appreciating Zoom more than they have. And you see this stock chart here. It's like the investors have run away from Zoom and never come back. You look at their PE ratio, 21, but their forward PE is only 11. Let's look at what analysts are saying. 20 analysts cover Zoom. They're saying hold with almost a buy rating. And they're all saying it's really discounted. It's a really discounted stock. Okay. So what would cause Zoom to take off and really go up in value, right? And that would be, a good, interesting conversation. Now, I can tell you, like I do Zoom video. I've done videos on the company Zoom, and I've had some really good comments that challenge my perspective, and I appreciate those. And the comments that I probably get more often is, well, they could be replaced by Microsoft. I believe their solution is Teams. Google has Meets, and you have these different companies offering video conferencing software. That's a known competitive item. But what I would point out is the user experience on Zoom. I happen to believe that it's superior to the others. Zoom is really focused on video conferencing, and now they're doing more things outside of video conferencing, like call center services, phone services, communication services, and that's great. And they've proven to be sticky. You saw their growth rate. I see their growth rate, and I'm like, okay, if they're being replaced by Microsoft, why is their revenue continuing to grow? And it's because people prefer Zoom. They prefer using the platform. It's really focused on video conferencing. It does it very, very well. In my work, I have different groups that I'm a member of. Zoom is used 95% of the time. The other 5%, Microsoft is used, Google Meets. But it's a very rare occasion when I actually have to use those platforms. And frankly, I'm usually having to kind of relearn those platforms because I use maybe Microsoft once a month, maybe once every 2 months, and I use Google Meets once a month, once every 2 months. So I'm optimistic that Zoom at some point is going to be more valuable from a stock price perspective. I also believe that it's a very good acquisition target. If you consider another company can come in and buy Zoom, add $4.5 billion of revenue to their top line. More importantly, they can add this type of gross profit, $3.4 billion of gross profit. Their cost of revenue is $1 billion. They're generating $4.5 billion of revenue. That's exceptional fundamentals. So if you're an Alphabet, a Meta, an IBM, somebody, this is a very good acquisition target for somebody that wants to immediately be the leader in video conferencing. And video conferencing is not going anywhere. It's here to stay. We're on YouTube. I'm presenting to you, and it's a worldwide audience. People are meeting on Zoom to do their work, school, socially. I'm a member of a couple groups. There's one group that is a church group. We do it on Zoom. A membership to another type of group, and this is all private stuff. We meet on Zoom. It's like Zoom is the preferred method of at least the ecosystem or the community and communities that I'm a member of here in Southern California. So Zoom, that's my opinion on it. That's a good stock to take a look at. Enkiter, I think you had another comment in there too. Let me see if I can catch up with that. I do hold Zoom. I've been holding it for some time. It's been one of those, like, I don't get it. I don't get it stocks. Like, why isn't it going up? It'd be one thing if a stock, like a company shows, like, for example, Apple wasn't growing. It was not growing. It actually had a decrement to top line revenue. And the stock really held up well. But it kind of had a flat, period of time to their stock price. I get that. I understand that's logical. Okay, they stopped growing, the stock didn't appreciate. But on the Zoom side, if they keep growing their margins, if they keep generating more free cash flow, why isn't the stock behaving consistently with the growth in revenue, gross profit, and free cash flow? We'll see. Some situations, Mr. Market is not going to give us a straight answer, and it's going to take time. Lynn Samuel, I'm going to get to the next comment here. Make sure I don't skip anybody. Okay. So Lynn Samuel, if you invest in dividend stocks and you don't want to take dividends right now, what happens to the dividend? So if you reinvest, you can reinvest the dividend, or it'll go into your cash position. Now, dividend stocks, and I'm going to speak about it, based on U.S., tax. So if you have a quality business that pays a dividend, and I'll put it out there like Allstate, right? Allstate puts a very nice dividend out there. And actually, I did a short this morning on Citibank, and Citibank pays 3.3% dividend, which is a nice size dividend. Now, if you hold Citibank in a 401k and it's basically being sheltered from a tax perspective, you'll get that dividend, and I think the rule is you have to reinvest it in the stock. You won't pay any tax on it. Now, if you hold it in an after-tax account, a brokerage account, then when you get that dividend, whether you reinvest it or you take it in cash, you're going to be taxed on it. It'll come out at the end of the year. It'll be part of their 1099 over to you, and you have to report it on your taxes and then pay taxes on it. So that's what happens with dividend stocks. Now, I don't analyze. If you've seen my videos, I never use dividends as the method to determine the value of a company. But I would say to you, now that I'm 55 years old, and as I look at retirement, I'm like, yeah, I want to have a situation where my portfolio generates enough income where I don't have to make a lot of decisions of, hey, okay, do I have to sell Meta stock? Do I have to sell Zoom stock before it goes up in value like I expected? Instead, my portfolio naturally produces income with dividends or interest on my bonds. And then those dividends in my after-tax accounts, I don't reinvest my dividends. I take it in cash. and I take that cash and I live off of it. I pay my bills. I travel with my wife. I buy stuff. I go out to restaurants. I do whatever I need to do with the income. So that's my comments on dividend stocks. Thanks for the question. And a comment on small caps. Yeah, small caps, if you catch them at the right time, especially so with small caps, you have to be a very good stock picker. You have to pick businesses that you think are going to do great. One example I'll put out there is, and it's not really a small cap, Airbnb. When they IPO'd, it was already a pretty good sized company. But why am I going to talk about Airbnb? Is one of the things that I really believe in is invest in companies that you have an information, if anything, an information advantage, or you really understand that business. You have some insight into that industry. Now, before Airbnb was public, I'm a real estate investor, and I bought, investment properties, and two of them we converted into Airbnbs in 2012. And 2012, from 2012 to 2022, we operated these Airbnbs. It was really profitable. It really worked. People would find us on Airbnb, and we'd find good, travelers, and it was a really neat business. My wife predominantly managed those two properties. So when it came around to understanding Airbnb as a business, I had the experience of being an Airbnb traveler, and I think millions of people can say that. But I owned two properties, and I operated them for 10 years, 10 plus years. I understood the value of Airbnb, and I understood the strength of their brand. Not only were we on Airbnb, we were on booking.com. We were on, I think there was two others, Flipkey, and I forget the last one. 95% of our reservations came through Airbnb. It was the dominant force in private home rentals. It really is more of a social experience when it comes to the digital experience. Like before Airbnb, there was call it Expedia, where you're finding a hotel, you're booking your airfare, and so forth. And I was an Expedia customer, and I get that. But that's taking kind of like old models, hotel rentals, airline rentals, and so forth, or airline tickets and so forth, car rentals, and kind of presenting it in a more modern experience. Okay, I get that. Airbnb is not that. Airbnb is hey, we got this new economy, which is the sharing economy, which is the sharing of private homes, which could be a vacation rent home and so forth, and then putting it online. So I understood it, and I went for it, and I invested big on Airbnb, and so far so good. I bought at the right times. I didn't buy when they IPO'd. I bought down here. Where am I going with this? We're back to small and mid-cap stocks. You have to be a very good stock picker to make money, to make good money, because there's probably going to be more businesses that don't work than there are that do work. And try to use the experiences in life or things that you find you're passionate about. If you love a particular kind of, like, I think it was kiter, right? You're an outdoors guy. Well, you probably have certain, things that you are just naturally really interested in. That could be your advantage. And go to those types of companies, small businesses, and you might know, hey, this business is really going to disrupt, this industry and do well. So you got to be a great stock picker in small caps, medium caps, because more small caps are going to fail than succeed. So you got to be really good at it. Chi Wong, very nice to see you. I think you've been here before. Hi, Victor. Hope you're well. I was wondering what percentage of cash you're aiming to hold for a correction. Thanks. Okay, so that's it. Thank you for the question. It's a very good question. So I'm going to tell you what the difference is before, so I'm a believer that, like I've heard online, some people hold a lot of cash and that's what they're comfortable with. Every investor should be kind of working their portfolio under conditions they find really comfortable to them. Okay. Now, my preference is to be invested, either invested in bonds and maybe own a 5-year bond and it pays me a really nice interest rate, but predominantly on stocks. It takes a while. Like I just showed Zoom. It takes a while. Zoom isn't even working for me yet. I think I'm losing money on my Zoom shares. Meta is doing great. I've owned it for years. It's doing phenomenal. Awesome. I went from having probably 8% of my overall portfolio in cash up to 16% right now. I sold United Airlines this week, Ali, MPW. Those were not giant positions. That put me into about 16% cash. Now, when a correction comes around, I just want to have enough cash so that I could, for example, Airbnb, which I have on the screen. Let's say a correction comes and the stock price goes 20%. I'm going to be buying Airbnb stock, and I'm going to be buying it in very good, big quantities. Let's say Meta came down and the market says, hey, we're going to correct and Meta's down 25%. I'm buying Meta. I'm buying Alphabet. I'm buying Adobe. So I'm going to buy more of these companies that I believe in, because quality companies will, if I believe Meta is going to be a strong business for the foreseeable future. And you can see that Mr. Market was really discounting it. Now, I'm not expecting a correction like we experienced in 2022. Not expecting that. I'm expecting like a 10%. But even very recently, Meta pulled back quite a bit, right? So when it does this, I'm buying. And so at 16% cash, I think I have enough to buy into a correction and take advantage of it. Now, I've heard, some investors out there being like 1/3 cash. Warren Buffett has like $160 billion of cash. That's a lot of cash. And man, that guy's ready to do just about anything. But I think it should be, what you feel based on how you manage your portfolio is a pretty good war chest of cash so you can use it. So hopefully that gives you a sense of how I do it. I'm not saying that's the right way or the wrong way. I'm just saying that's what I'm doing. And I think I'm in a good place right now. 16% feels good. I'm going to continue to monitor. I always classify myself as a active investor. I'm not a set it and forget it guy. There's one term that I was talking to another investor yesterday, and the term that, hey, you buy it and hold it forever. I don't see how that gets repeated too many times. It's just illogical. Warren Buffett just got out of Paramount. That's an example of the most famous value investor getting out of a position. He didn't buy and hold Paramount forever. He realized that it was the wrong investment and got out of it. So that's an example of some of these sayings or words of wisdom are not completely followable. That's not a word, but I'll use it. Anyway, thanks for the question. I appreciate it. All right. So Bows 375. Hey, thanks for joining. I don't know if you've ever been on, but I appreciate you joining. And you asked about Noble. So I do remember you were on. I did look at it more closely. This looked good. And I looked at it more closely, and it's NE. So Noble operates offshore drilling, and basically when oil prices really go up, this stock's really going to take off because the oil companies are going to say, hey, we need to find more reserves because the demand for oil is much higher. And these guys have been around since 1921, and they're headquartered in Sugar Land, Texas, which is outside of Houston. That's where the energy complex is located for the United States for oil companies and also natural gas. And these guys, their fundamentals look great. Now, the reason why I'm not buying Noble is that Chevron is the third biggest position I have in my portfolio. So going any more into this complex, and Chevron does do drilling, they explore, and they find more oil reserves. Noble is a company that will do that for another company. So it's almost like a contractor. I really like what I'm seeing. Revenue is 2.6 billion. When we look at their growth rate, they're growing really fast. Okay. That's very impressive growth. The market cap 6.5 billion. Here's a small cap. Remember we were talking about, hey, you got to be a good picker. I mean, I really looked at, should I start a position here? Their PE is very reasonable. They're growing at 83% and their PE is 14. My God, man, that looks awesome. 4% dividend. Analysts say it's 32% discounted and that it should be a buy. These are all like green flags, right? There's red flags like look out, stop. These are all green signals that this is a good company. The piece that, this could be boom or bust. Like if oil prices do drop, this stock would probably suffer. But so far, if you look at the stock, it hasn't been like screaming up. It's been going up and to the right nicely. It's up 86% since they IPO'd. So a lot of things that I see in Noble, I like. And now that I'm looking at it again, I looked at this in the live stream we did last weekend. I took it away as one of the stocks that I was going to look into. And now that I've looked at it again, I'm going to put it on my list to look at it again because, you don't find these types of fundamentals every day in every stock. It's very good fundamentals. Debt to EBITDA, 0.66. I mean, this is all like a report card using that analogy. This is all straight A's. This student is getting straight A's. Very good return on invested capital, not breaking any records, but it's good. And free cash flow is good. So I'm going to look at this again. I would encourage, it looks like you're interested in it. I would encourage you to do your analysis. I never give investing advice like you should buy this stock, never. But I'm just giving you my opinion, which is the fundamentals on Noble are really good. I'm seeing a lot of like positives here. Analysts agree. It looks good. If we look at the earnings per share, 3.28 is what it's expected this year. It's down from last year, but then it's going to grow up. See this boom and bust? That's what I'm talking about. The drillers for oil, I mean, this is like, it's a little bit of a gamble. You have to catch it at the right cycle. It's almost like shipping stocks, like Zim is one of my shipping stocks. You have to buy them at the right time because when you have, difficult periods, you're going to see this stock really come down like here. And there's not a lot of data here. We would want to see more data, but the biggest company in this space is what's that? Is it Halliburton or there's another company out there and I can't think of their name, but they're the biggest one in this space. So take a look at it, maybe compare it against a couple of their peers. And then you need to make your decision on what you're going to do with Noble. But I appreciate you bringing this stock because this is a really interesting stock to look at. It shows a lot of good things, and it's making me look at it again. I'm going to put it on my list, and I'm going to look at it again this week. Thank you for coming back, and thank you for talking about that stock again. So cinematographers agreed on Adobe assessment. I appreciate that. Okay, so Bo's brought a really good stock. Now he's talking about CEY. So mining stocks. So, and please comment on this. Is this kind of like an area that you're really interested in? Because we just talked about oil exploration, and now we're going to talk about mining. Is there something there that you have a competitive advantage on? Meaning, yeah, I worked on an oil rig. I work for an oil company, or I work for a mining company, or my family's been in mining for 100 years. Be curious to understand that, which may give me more insight into why you're looking at exploration type stocks. In the meantime, let's take a look. So I'm pretty sure it's not that one. So CEY, so LSE. So I'm not finding this guy. Why am I not finding it? So LSE. Am I getting the symbol correct or incorrect here? So TSX, CEE. So it looks like this is in the Toronto Stock Exchange. Maybe that's why I wasn't seeing it. Yeah, so this is probably it. So this is a mining stock. It had really good days back here, and recently it's doing okay. It's up 41%, yeah, better than okay. It just had a very good correction at the end of, I guess, toward the end of 2020. So these guys explore for gold and other precious metal. Okay. Okay. Headquartered in St. Helier, Jersey. So okay. So they're a mining stock. And these stocks here, I'm out of my zone of like knowledge and passion and interest. I've never been a gold investor. It just doesn't do it for me. But let's take a look at the fundamentals. So I'll kind of disqualify myself as having insight like I shared on Airbnb. That's not the case here. But let's look at fundamentals. So $2.6 billion market cap. The revenue is pretty good compared to that market cap, 1.22 billion. Let's see the consistency of revenues. So it's been pretty consistent. You look at the growth rate in the last couple of years, it's really good. They had a down year in 21. Okay. Maybe gold prices were settling down. These guys are going to be dependent on the price of gold. They've grown nicely over time. They've 687 billion in 16. Now they're 891. All right. Looks good. Net income is there. Free cash flow is there. This year, in 2023, it was good, 150 million. But last year, 2022, the previous year, 16, wasn't very good. See how it's a little scattered, or I should say inconsistent. And it's probably because miners have to put a lot of capital back into their businesses. They have a new mine. They have to put a lot of capital into it. And that's what might be taking away a lot of that free cash. I do not like seeing this because, are you buying into a company and then for the next couple of years, they're going to have negative cash flow? That would be, limiting. So that would be one red flag that I would put out there for the stock. When we look at their debt to EBITDA, they don't really have any debt. Very good. Very good. That's important to a mining stock. That way they don't have to make debt payments, especially when it's like gold prices are down. They can just slow their operations down. That they don't lose too much money and they're not having to operate just to pay debt. Very good. So this would be an interesting stock to those that would be interested in a mining stock for gold. The fundamentals look okay, not as strong as Noble. And Noble is in a space that I do find kind of like, that I do have some knowledge in, but not on this one here. I wouldn't be able to share much on what is CEE. Okay, thanks for bringing that up. Yeah, thanks for showing up, Mr. 123 Cheetah. Appreciate it. And then also Mining Corporation, AEM is interesting. Okay, so AEM. There is like, I've gotten into miners that do, they mine for iron ore, copper, and things like that. I've invested in those because I do understand, what copper means to the world from an economy perspective, and steel. So I've gotten into BHP a number of years ago. That was a good investment, pays a really high dividend. And now I do have TX, which is they predominantly are a steel producer and they do mine for a lot of their ore. So that is one of the miners that I've invested in. So this one here, which is Agnico Eagle Mines. They are a gold miner. They are going after precious metals. Okay, cool. So this is kind of back to the previous stock that I looked at. Is I'm not big into this space. I don't have a lot of knowledge into the space, but let's look at their fundamentals. So revenue, market, this is a bigger company, bigger market cap. They pay a low dividend, but again, we're not going to use that to value it. Really nice growth. Man, great growth. You look at their last 5 years, very good growth. And if we look at their free cash flow, see, this cash flow is more comfortable to me. The company we just looked at, the up and down cash flow, that kind of scares me. Looks like this is a bigger company that probably has better forecasting ability and is putting their capital to work in a more thoughtful, consistent and predictive way. So this looks good. This looks good. If I look at the market cap, 37 billion, and I look at their free cash flow, I don't know that I'm going to get to that market cap. Not with cash flow. I think the best I can do with cash flow is get to about a $20 billion market cap. I think the reason why it's priced nicely high is that their revenue growth looks really good. And a lot of analysts really just use earnings per share. There's 6 analysts covering this company. They say it's fairly priced. It's priced at a discount of 4.73. And they use earnings per share as the predominant method of valuing companies, which, I understand. I use free cash flow, which is principally like what Warren Buffett and other investors use. And I also use earnings per share as an influence to my overall valuation. But this one here, it looks like earnings per share are actually going to come down. So it's expected either that gold prices are going to come down, or maybe the cost of doing business is going to go up. Probably gold prices are expected to come down. And so this is kind of a red flag, right? Hey, earnings per share is going to come down. And a good part of the valuation is being drawn from this earnings per share. I can't get to this market cap using their free cash flows. They are growing their free cash flows, but I can't get to 37 billion. I can get to about 20 billion, give or take. And earnings per share looked a little risky. So this one here doesn't look all that great once I take a closer look at it from a fundamental perspective. And as mentioned, I'm not a gold miner investor. I probably will not be anytime soon. All right. So, and Kidder, we talked about Zoom. Appreciate you bringing that to the live stream. Winter is coming. Wondering if you have any thoughts on Globe Life, ticker GL, after the recent semi-scandal SEC investigation. The stock has cratered. Okay, so let's take a look at symbol GL. So these guys are a life insurance company and an annuity company. I own Prudential, and I just sold Prudential a couple weeks ago. I did really well with it. I bought it at the right time, sold it at the right time, I think. And so I can't get into like the problems they're having, but it's really important to understand them. Is it something that, like, for example, 3M has had a lot of legal problems. Now, I believe 3M is a very good quality company. I believe their employees are really good. It's a very respected company. 3M produced earplugs that for some reason they were not good enough, and they caused loss of hearing in a lot of military people. That's terrible. Overall, horrible. I don't think that 3M obviously didn't mean to do that, and they made that big mistake. They're paying for it, and they should. That situation, I'm a 3M stockholder. I bought them, and I'm doing well with them. And I believe in 3M, and I don't think they're going to repeat that, that type of error anytime soon. And I don't think they intended on doing that. Having said that, when you look at Globe Life, you got to look at what business problems are they having, what legal problems are they having. Is this something that's happened before? If it did, it's almost like, okay, I would never touch a stock like that. I'm not going to buy into a company that's probably going to get themselves into trouble more habitually than maybe a one-time event like I just described with 3M. I don't think 3M is going to get themselves into that situation anymore. 3M's been around for more than 100 years. For the most part, they've been a really positive company. So I would really do your homework there. And then looking at the fundamentals, they're a growing company, looks good. They cratered. Yeah, they went from 120 down to here, but they've kind of recovered some of that gain. If I look at from a high level, could I get to that valuation? Free cash flow is 1.4 billion. Okay. Yeah, I could value this company above 8 billion very quickly. They're growing and they have very good cash flow. This company should be valued at around 20, 25 billion, but they have this legal situation. So first order of business is understand what's going on with the legal business and who had they been for the last 10 years. It looks like they've been around, fairly consistent company for a while. So what's going on? This is an interesting situation. I think I'm going to read into it and see what's going on. I think it's worth understanding what legally they did and then see if it was one time they had a couple bad actors at the company's doing the right thing and repairing whatever financial, problem they created and then get themselves out of it and get back into the business they were. I think it's worth looking at. I'm going to look at it, if anything, because if I believe that, hey, these guys are, as a one-time thing, it could be an opportunity to buy a really discounted business and then see the stock rise, over the next couple of years as the market gets more confident in the business. Now, I'm going to be really careful because, I just sold MPW, and the reason for it is that it was just too much of a distraction. I think MPW is likely going to come back to its, glory days, so to speak, and probably come back. But I'm really trusting in a management team that got themselves into a bad tenant situation, their biggest tenant being bankrupt. And well, that's kind of like they get an F minus, the management team, for ever signing that type of tenant and ever depending on one tenant that much and not seeing that they had financial problems. So the long and the short of it is, I'm not eager to get into rebound stories. I have to be very careful. I'm more eager into buying high quality stories that I really believe in. Alphabet, Meta, Airbnb. So these stories I really believe in. Are they all going to work out the way that I think? No. I just told you about Zoom. It has not worked out the way that I want. But I believe in Zoom. I think they're going to be bigger in 5 years. I think they're going to be much bigger. And at some point, I think the market's going to recognize that. Back to this one, GL. I have to be very careful with rebound stories. I'll take one once in a while, but I've probably lost more money on rebound stories than I made. And it probably was too much of a distraction. I'd rather find the next Meta. I'd rather find the next Netflix. If I can find the next one or a couple of them that perform like that, I'm going to do great. So I'd rather spend my energy and time and focus on that. Good luck with GL. I am going to look at it, but I'm going to be very careful. All right. So moving on. Android PC. Thank you. Thank you for coming. So BlackRock could start offering indexes, exchange traded funds for private. Yeah, I heard about that. And, again, everything I share is just my observation, and we all invest the way we want to. But I don't like ETFs and funds where I don't understand the investments or I don't have enough good actionable data. And once you get into private markets, they don't have to show you the companies in their financials. And I'm like, okay, well, that's a non-starter for me. If I'm going to be investing in private companies that, um, I'd rather just start my own business or buy a business. Okay. But to buy into private businesses where they don't have to show you all the details like a privately traded company, that's a non-starter for me. So I wouldn't be interested in this BlackRock, exchange traded ETFs. Maybe some people will, but not me. All right. So not political opinion. I'm hearing friends are concerned if B wins, tax reduction next year could cause plummets. I think let's talk about politics and keep it to what it would mean from investing perspective. So I think the two candidates that are up for election, Trump would be very pro-business. And I think he would make some changes that would probably benefit the wealthier, investor. I think I'm pointing to the obvious. I think he's going to be anti-China. So I think China is going to be, kind of handcuffed a little bit. And I think that would kind of play its way out. I think if Biden wins, we're going to pay more taxes. But the last, 3.5 years have been pretty damn good for the stock market. So if I'm going to make more money and pay more tax, I'm okay with that. I'm okay with either one winning. Okay. The U.S. is going to be fine. I think the stock market is doing well. I think the economy is in a good place. I don't see anything big like another COVID coming or hopefully, I hope we don't see a war coming. So I think we're going to be fine. So I think the election is going to draw a lot of interest. I mean, you hear about it on CNBC and you hear a lot of comments around it. It's a lot of noise, in my opinion. I think either president, once we get through that, the economy is going to be fine. And there would be a difference in, okay, we got to pay a little more tax under Biden. Oh, we're going to have less taxes to pay under Trump. I'll take a good economy and a good stock market. What the voters decide in November, okay, that's not in my control. Obviously, I'll put in my vote, and then we'll just deal with whoever gets elected, and we'll go from there. So, I'm not going to let it be a big distraction for me. It's whoever wins. We'll have that as president for the next 4 years. I like where the economy is. I like where the stock market is. I think it is overpriced. I think we should naturally have a correction of some sort, a pullback. It's just natural. I'm not saying, I want bad things to happen. I just want it to kind of make sense. And this up market has been kind of nonsensical. And I think we covered this one earlier. I hold a position. The company has done well. Yeah, excellent, man. Very good to hear. And then thanks for looking at NE. You hold a position. I have no experience. I'm using. Okay, cool. So the thing about experience, right? You don't get experience until you experience it. And I think by you holding an energy, exploration company, just keep learning and keep adding. Because if you find a space where you become good at it, just keep in that space, man. And I think that the knowledge you're getting there is probably going to be very useful. I have, like I said, I worked at an oil company. Doesn't make me an expert on drillers. I just understand where they work within that whole ecosystem of oil companies. And it could be very, very productive for you, very profitable. So good luck with that, man. I really like the topics you bring to the live streams and makes this go really deep. Really, today's live stream, you guys have brought it, man. You guys have come up with really good companies. You had very good comments to begin with. Good job. Any more thoughts on Paycom? I like Paycom. It's a software company. And I told you about how Zoom is being disrespected. We're getting ready for American football season. I got to start talking like the football players do, disrespected. And when you look at, man, look at this drop. When you see this stock chart, you're like, what's going on? Did these guys like totally like screw up? Are they doing poorly? And no, they're growing their business. That's what they've been doing. Why are we seeing this type of growth in revenue, and we're seeing this type of collapse in the stock? Those are like contradicting each other. So I like Paycom. It's a stock that I'm following. I haven't bought into Paycom. Remember the earlier comment? Be very careful picking small caps because they're doing this kind of stuff. And what do I do with this? It's like, okay, this company's unappreciated, undervalued. I think the stock's going to go places. So I'm watching this stock, and as soon as I see, like, this past week was maybe a signal that, hey, small caps are going to begin to work, maybe I do buy some Paycom stock. So overall, my comments are that I'm following this stock. I looked at it carefully. It's worthy of like paying attention to it for me. And if I see small caps begin to work and Paycom continues to grow their business the way they've been growing it, I'm probably going to own this stock at some point in the future. So, and thank you for bringing this company up. You brought it up like a couple weeks ago. I looked at it briefly on the live stream. I looked at it in depth, and I like what I'm seeing. Shadow Guy. Thanks again. Different topic. Municipal bonds. I own MQ. So I bought one municipal bond. And so what is a municipal bond in the scheme of bonds, right? Municipal bonds in the U.S., I know Shadow Guy, I think you're in Switzerland. So I'm just going to speak from my perspective as a person in the U.S. So municipal bonds in some types are completely tax-free. You don't pay federal tax. You don't pay state tax. In some, you do have to pay federal tax, but not state. Some you pay federal tax and only state. The tax treatment it varies by the type of municipal bond that you buy. But in essence, you avoid paying tax. And I've looked at them. Now, it was the return on investment for my research into them. It wasn't high enough. And I had, what I would say is that if I'm having to spend a lot of time to figure out how to make 1% more in yield, like I'm spending a lot of time, but I can figure out how to make 4 or 5% more in yield on stocks, I'm going to spend my time on stocks. I buy bonds in a simple format because I want the stability and I want the income. And I would say, with the exception of one bond, and I own like, I don't know, 50 or 75 different bonds with different maturity dates and so forth. I stick to corporate bonds is my number one bond type. And I just started buying into Starbucks with a 5-year maturity, meaning I'm in August of whatever year it's going to be, 29. They're going to give me back the face value of that bond, and they're going to pay me interest between now and then. That's a corporate bond. It has a very good yield. So I bought into that. Simple. I know, understand the yield, and it has a term of 5 years. I'm good. So when I got into munis, I just thought the additional understanding, especially the tax laws, some are taxable by the feds, some are not taxable by the feds. I was like, man, I'm really spending a lot of time trying to figure out how to make a little bit more. I'd rather set my bond strategy to be simple and effective, and it gets me what I need. And I'll make the extra money on stocks because my return on investment there is much better. So I don't know if that helps, Shadow Guy. I'm familiar with the term municipal bonds and municipal ETFs. I don't know, but I buy individual bonds. And hopefully that helped. And I don't know what the return is. The other thing that I noticed about municipal bonds versus corporate bonds is that they had a lower return because their benefit was, okay, well, we're not going to tax you. But my rationale is um, you're going to get taxed on a greater gain, or you can go to a municipal bond and not be taxed on a smaller gain. Well, which one's better, right? I think at the end of the day, they kind of equalize each other. And I'd rather just understand a simple process, buy bonds, buy them at the best yield curve, and then, just have them there, kind of, have them as kind of a side uh, portfolio that I don't have to spend a lot of time and energy, because I'd rather spend time and energy on stocks where I can make a big difference, 5-10% on a given year. Right. So those are my comments there. And thank you for asking. All right. So Blade, been holding since 2018. Yeah, that's a pretty wild ride. I think it's a solid business, but as you're experiencing the stock market, it could have a very unreliable and unforgiving, and at times just a very sinister effect on a company. How can Paycom be, the price be dropped so much? It's the same thing that when you look at, how did Meta over the last 5 years, how did the stock market decide, what, Meta's not a good business, I'm going to discount it by 76%. This is in the last 2 years. Okay. How did the stock market decide Meta's not a good business, we're going to discount it by 76%? So this is kind of like in the same, kind of neighborhood of thought for me. Is that's where Paycom's at. That's where Zoom is at, is they are being discounted by the market. The market sometimes is nonsensical. And at some point, I'm expecting that Paycom is going to get on an upward curve. But small caps have not worked for the last 2 years. Zoom, Paycom are good examples of that. Big caps have really worked. Meta is a very good example of that. It's really just taken off 448% since the low point in 2022. So that's the game we're playing. Hopefully you own other stocks that have just been killing it, because stocks like that can really just frustrate an investor. So SoFi, we've talked about SoFi. It must be the most undervalued stock out there. Well, I don't know. I don't have that opinion on SoFi. So here's SoFi, and it's really had a really interesting ride. It IPO'd in, I guess, 2020, and last year, for the 1 year return, it's down 2%. So I think when I covered SoFi, we went over it. I think they are growing their business, which is interesting. But the stock that I believe in that kind of comes into this new investor, new generation, younger audience, younger customers, Robinhood. And Robinhood is doing really well. So Robinhood's up 78% in 1 year. Year to date, it's up 80%. So Robinhood is what I thought was a better investing opportunity than SoFi for me when I made the decision. And, I think Robinhood has a very good experience for the younger investor or account holder, because they are doing like online banking and so forth. They do crypto. I think Robinhood's really doing a lot of good things, and they are not taking away, but I should say, when you look at these big banks, JP Morgan, or you look at the big brokerages like Charles Schwab, they tend to be really focused on that 50 to 70, 80-year-old audience. That's where a good portion of the wealth is, right? Done. Okay, I get that. But the people that are 20 to 30 and 30 to 40, those guys grew up with phones in their hands and computers and video game consoles. And those guys will someday be 50 years old and have lots of wealth. Robinhood is dominating that younger space. And so is SoFi. I think SoFi does things that really cater to that younger audience. But if I was going to pick between Robinhood, and I picked between Robinhood and SoFi, I went with Robinhood. I'm glad I did so. So that's my opinion on SoFi. Hey, cinematographers, I really appreciate what you brought this week, man. You brought a lot to the table. Thanks for coming. Ulta, winter is coming. So I've looked at Ulta in the past, and there's a couple of things that I don't like about Ulta. One is their retail business. And two, they really had a very nice rise. I think what how they run their business is very respected. But to begin with, I want to buy businesses that, and I think if you guys saw this video here, where I present kind of like my four quadrants of where companies land based on their industries, and you have businesses that are really desirable in the green here that have very strong barriers of entry, and those barriers are very strong. They just keep competitors out. Google search, Microsoft, their desktop applications. Those are two examples. As soon as you get into retail, like Ulta is competing against 100, if not 1,000 competitors in the space, from Macy's, the pharmacy stores that sell makeup, but they do it a little different. They have really good consultants that will help a person make decisions on their cosmetics. So they really grew quite well. Now, the consumer is beginning to feel like they don't have a lot of money. For a couple of years, with the US government pumping a lot of money into the economy, where they're like, hey, we got COVID, everybody stay home, we're going to send you stimulus checks. I'm sure a lot of people felt like, hey, I'm going to go buy cosmetics because I have this extra money. I want to feel pretty. Okay, great. So they went off and started buying Ulta products. But I think they're beginning to hit the wall, and their stock price is showing it. I'm not an investor in Ulta. When I look at Ulta, I don't feel like it's an investment that I want to make. They're down from their peak about 27%, which isn't too bad. And their peak was in early 2024. But it's not an investment that I saw great value in. It's not like hey, I mean, they're discounted by 80%. And I actually think it has a lot of risk to it. I don't like the industry. I just shared why. They have too many competitors, and these guys are selling into like the premium area of cosmetics. You can buy cosmetics at the pharmacy, at the not the grocery store, but at a Macy's, or at a general store. And of course, you can go to Ulta or one of their competitors and buy like the premium stuff. So that's why I'm staying at Ulta. Those are my comments there. So, Family Guy, any thoughts on Genius Sports? Genius Sports. What do these guys do? So, engages in development of sale technology-led products. Okay, so these guys do online, so technology that will be used for the online gambling, online betting, sports, betting websites. Okay, I understand that. So it's software. It's predominantly like code based. Okay. Market cap's really low. Small cap. Remember, you got to be a really good stock picker if you're going to play in this game. Revenue's pretty good. Net income is terrible. They're losing money. So you got very good growth in revenue. Okay, that's fine. They've been losing money. Okay, might be understandable if they're in growth mode. Free cash flow. So free cash flow is negative. Okay. So the encouraging thing is that they're burning less cash. In 2023, the cash they were burning is lower than in 22 or in 21. That's good. Let's look at their balance sheet. So they're burning $32 million a year in cash. And if we look at their balance sheet, they got $100 million. How much debt do they have? Total debt 14 million. So not too much debt. Good. So they theoretically have 3 years of cash to operate with. Okay. So when we look at their stock for the last 5 years, wow, that doesn't look good. That doesn't look good. So I think what's scaring off investors is they're not profitable. They're burning cash. I think there is a fair amount of competition in this space. They're heavily discounted, strong buy, but just the stock isn't going to the right places. This one here, I mean, I don't gamble a whole lot. I think I gamble like once a year, maybe bet on the Super Bowl. If you think like back to what's your zone of like knowledge and man, maybe you are totally into, sports and understanding what odds are and all that stuff. And if you do have like a passion there and you feel like, hey, these guys have the best experience or they have the best, thing, or they have some type of advantage that you think is going to play out and put them on top, that's one thing. For me, I would pass. There's just too much risk, way too much risk. This is first, they don't have positive cash flow, so I can't give you a valuation on this stock. If we look at their forecast, they are losing money, so I can't give you a valuation using free cash flow or earnings per share. And I don't have an information advantage here. So this is a complete pass for me. But I would, put that out there that if you have an information and knowledge advantage, maybe you can use it there. Shadow guy. So you're a U.S. citizen. Oh, okay. Sorry about that. I ran with the wrong assumption. So the yield is 5.58. That's pretty good on I think that was an ETF or a mutual fund for a municipal bond portfolio. So that's pretty good. Cyan Ken, lithium stocks. Yeah. So, lithium stocks were supposed to be super important and valuable 2 or 3 years ago. And that ended up not being the case. And it was all for batteries, which we need, right? We need them for phones, cars, everything. And it came and went. I feel like the lithium stocks of today that are probably going to crash and burn are power companies, utilities, because utility companies, and I just filmed a video, you'll see it on a utility stock this week. The stock went up 250%, but their revenue is coming down. It's like, well, how does that happen? It's because everybody thinks that AI is going to increase the power consumption significantly. And these power companies are going to be able to like double and triple their capacity and their revenues. And to me, it's like really like building a power plant is not easy. It takes like 5 years. It takes a lot of capital. It's very risky. So that whole like lithium was supposed to be this like, oh man, if you can control the supply of lithium, you're going to make lots of money. And that hasn't been the case. I think lithium is not played out to be a great investment. So I didn't buy any lithium stocks because I just didn't understand it enough where I can make an educated and informed decision. That's what kept me out of them. But I do remember that happening. Ulta, I think I will buy more in the future despite the competition. Okay, well, I hope you buy it and I hope you double your money. And I really do. I hope everybody makes money. Good luck with that. Okay, so I remember I told you about Clove 2 months ago. You did intrinsic for it. And I said Clove will lean into a SaaS in the future. Wow, cool. So am I looking at the right stock here? So I remember I told you about Clove 2 months ago, man. I'm not sure I'm looking at the right company. So Okay. I wasn't looking at the right company. Man, these guys are looking good. So these guys do. I still don't think I'm looking at the right. No, they are. So they do software for insurance payers. Yep. So this is a software company that's really growing. SaaS is software as a service, and that's the new way the companies want to buy software. What's interesting is quarterly, they're growing a little bit. The stocks really rallied. For some reason, they had really bad, revenues, but it looks like they started to grow again. That's good. Maybe they had a switch in software. Excuse me, the way they sell their software from the days of on premises where they sell the software and the customer needs to buy servers and run it to a full software as a service experience. So this is a tiny company, 750, very good revenue. You're buying the company for less than its revenue. So we looked at revenue. Are they profitable? No, they're losing money. Cash flow. So cash flow is still negative, but it's almost. I don't think I'm looking at this right. So cash flow, operating cash flow. So free cash flow is negative 116. Yeah, this is a tough one for me. It's done well. Something is compelling investors to buy into this company. It's really taken off. So hopefully you own. So hopefully you own the stock and you participate in that rise. I think if they have the right solution, having a SaaS solution for this space is probably going to be good because healthcare is pretty stable. We need it, whether good economy, bad economy. So thanks for bringing that back. Good luck with that. All right, so I'm going to go maybe another 10 minutes and then shut this down. MBot. Almost forgot. Remember MBot? They just put a nanobot inside the first human. Yes, it's still alive. You wonder. Wow, dude. Let's take a look at MBot. I always joke around that we're going to end up with like computer chips in our brains because we use so much technology now. And here it is. Wow, look at that. So they do invasive surgeries with little robots. Tiny company. Wow. This is a company where you got to really know your stuff or you got to be really lucky. So if you really know your stuff in this space, you can pick the right companies and make money. I don't. So this wouldn't be something that I could play in. Analysts say it's 548% discounted. Wow. It's really come down. It's a dollar stock, which is concerning to a lot of investors, including myself. They lose money. So we'll see where that goes. But it's interesting that companies, I own United Therapeutics, which is, we have, so United Therapeutics has a primary business where they do pharmaceuticals that help a lot of people with these rare diseases. But they're also looking to grow organs that would be transplanted into humans. They call it transplant xenology. And it just blows me away that they are trying to do this and then at some point get FDA approval. And you think about people that are waiting for organs or they're going to die, right? That's a pretty I'm going to call it noble and far-reaching goal that they have. So it's interesting. The life sciences, how far they're getting. All right, so I'm going to kind of fly through these a little bit. So the gambling space, yeah, good luck. I have friends that love the gambling space, and more power to them. It's not my gig, But hopefully you find, some good stocks that are multi-baggers for you. Marty C Love. Not sure what that means. But, okay. Do you like Citibank? Maybe. I like Citibank. It's done well. I'm gonna keep holding that stock. Yeah. So, if you got some or not inside information, good information, using inside information is illegal. On Clove, go for it. And please keep bringing it back. Like, I'd love to see that you bought into these guys and you just keep taking off and you make lots of money. I hope that's the case. Keep coming back with that story. And yeah, small caps, man, it's going to be tough. So I'm going to be careful with small caps, but continue to look at them, especially if it's in an area of knowledge that I feel like I've got an advantage there. I'm going to look for some small caps. If they start to work, we'll see. I think they should, because they've been down for so darn long. We'll see. So just in closing out, just a reminder, I'm an individual investor. I don't recommend you buy, hold, sell any of the stocks that I covered. Just weigh your decisions very carefully. It's been a great session. Thanks for bringing it today. You guys came with a lot of good stocks to look at, and you came with some really good comments and some good research. So thanks for doing that. So I really appreciate it. And let me catch this one here. I was referring to C Love once you typed. I don't know what you're referring to there. So is it Clover? I'm not sure, but send me a message on the site and I'll try to get to it. Anyway, everybody, enjoy your weekend. It was a really good session. Really appreciate all of you, and have a nice weekend. We'll see you.